2 years ago, I started putting real money into SCHD, and for a while, it felt like I had made a mistake. I bought because I wanted something stable, something boring, something I could trust. But then the doubts started creeping in. The price barely moved. Tech stocks were absolutely exploding. Everyone was talking about AI, not dividends, and SCHD felt forgotten. But over the past 3 months, something changed. SCHD quietly climbed nearly 5%, closing at $28.55 as of January 9th, 2026. I don't think this is a random bounce. I think this is the beginning of a comeback that could define 2026. And today I want to show you why I believe that based on how this fund is actually built. Hi everyone, my name is Steve, and today we're doing a deep dive into SCHD, the Schwab U.S. Dividend Equity ETF. In this video, I'm going to walk you through why SCHD has started climbing again after years of stagnation, what the 2025 Reconstitution taught us and why it matters, and what we can realistically expect from the March 2026 Reconstitution. Let me walk you through why 2026 could be one of the most important years for SCHD in recent memory. 4 major tailwinds are converging simultaneously. First, the interest rate environment. Lower rates are great news for dividend stocks. When bond yields drop, dividend yields become more competitive. Companies also pay less interest on their debt, which means more profit, and more profit means room to grow those dividends. Second, valuation resets in growth. I love innovation. I own tech stocks, but let's be real. Many AI and growth stocks are priced for absolute perfection. When expectations are this high, even great earnings can disappoint. That's when smart money starts looking for quality at reasonable prices. That's SCHD territory. Third, the demographic wave. 10,000 baby boomers are retiring every single day in the United States. These aren't speculators. They need income. They need predictability. They need sleep well at night investments. And fourth, the Reconstitution. This is the most critical part of this entire video because SCHD isn't static. It evolves systematically every March, and the 2026 Reconstitution is likely to reposition this fund for the next phase of the market cycle. Let me show you how. Most people think dividend ETFs just buy the highest yielding stocks. That's a recipe for disaster. SCHD does something completely different. It tracks the Dow Jones U.S. Dividend 100 Index using a strict, rule-based methodology that filters for quality above all else. Here's the exact process. Step 1 is the durability filter. Every company must have paid dividends for at least 10 consecutive years, no exceptions. This immediately eliminates unstable businesses, hype stocks, and companies with unproven track records. Step 2 is the quality ranking system. This is where SCHD separates itself from every other dividend fund. Companies are scored using 4 fundamental factors. Cash flow to total debt, which asks, can they actually sustain those dividends? Return on equity, which asks, are they using capital efficiently? Dividend yield, which asks, are they rewarding shareholders? And 5-year dividend growth rate, which asks, are dividends consistently growing? Only the top 100 companies by this combined quality score make it into the fund. Step 3 is market cap weighting. SCHD doesn't overweight based on yield. It weights by market cap, which prevents dangerous concentration in any single stock and maintains proper diversification. Step 4 is annual reconstitution. Every March, the process repeats. Companies that no longer meet the quality standards get removed. Companies that have improved their fundamentals get added. Sector weights naturally shift based on where quality exists. This is not emotional. This is not reactive. This is a systematic evolution, and that's exactly why SCHD has staying power. The 2025 Reconstitution taught us something crucial about how the system works. SCHD leaned heavily into energy, making it the fund's largest sector at nearly 20%. Major positions, ConocoPhillips, Chevron, strong cash flows, high dividends, fortress balance sheets. On paper, the fundamentals were flawless, but then reality hit. Oil prices dropped. The global oil markets became unpredictable. Energy volatility became a drag on the entire fund. Now, here's the important part. This wasn't a methodology failure. It was a stress test. SCHD didn't panic. It didn't make emotional adjustments. It just kept executing its process. And this is what makes 2026 so compelling, because now the system gets to respond, not based on predictions, not based on guessing where oil will go, but based on updated fundamental data for thousands of companies. The March 2026 Reconstitution is going to be fascinating because SCHD methodology doesn't care about narratives. It cares about cash flow, return on equity, debt levels, and dividend sustainability. And right now, the data is pointing towards specific sector shifts. Here's what we can expect. SCHD is likely to reduce energy exposure, not because energy is bad, but because concentration risk and volatility hurt the quality scores. It'll probably trim some financials because banks face margin pressure in falling rate environments. It's likely to increase healthcare, which is defensive with strong pricing power, essential products, and benefits from aging demographics. It should increase utilities, which have regulated cash flows, are rate cut beneficiaries, and enjoy lower cost of capital. And it'll likely increase telecom, which represents essential infrastructure with reliable dividends where debt becomes cheaper. Here's why this matters. These aren't random sector bets. These are the natural outcomes of a quality-focused system adapting to a falling rate environment. Healthcare companies, like medical device makers and pharma with strong pipelines, pass SCHD's quality screens. Utilities with regulated revenue and strong cash flow pass the screens. Telecom infrastructure companies with consistent dividends pass the screens. The Reconstitution isn't predicting the future. It's responding to present-day fundamentals. And those fundamentals are saying these sectors offer the best combination of quality, cash flow, and dividend sustainability right now. That's the entire genius of SCHD's approach. Let me be clear about something. SCHD is boring by design, and that's exactly why it's powerful. It removes emotion from investing. It removes the temptation to time markets. It removes the fear of making the wrong choice. You're not trying to guess which dividend stock to buy. The methodology does it for you every single year. And here's what happens when you combine that with dividend reinvestment. The dividends you receive buy more shares. Those shares generate more dividends. Those dividends buy even more shares over 10 years, 20 years, 30 years. That compounding becomes extraordinary. This isn't a get-rich-quick scheme. This is a wealth-building machine. And the 0.06% expense ratio means you're keeping almost everything. Looking back on the 2 years I've been investing in SCHD, there were moments, real moments, where I doubted this fund. I'd check my portfolio and see SCHD basically flat, while AI stocks were up 50, 100, 200%. And I thought, did I make a mistake? Should I have been more aggressive? But then I did something simple. I looked at my dividend payments, and you know what? They kept growing. Quarter 1 up, quarter 2 up, quarter 3 up, quarter 4 up. Even when the stock price barely moved, the income kept increasing. And that's when it clicked for me. SCHD isn't trying to impress you. It's not trying to win a performance contest. It's trying to support you quietly, consistently, systematically. Look, SCHD will never be the sexiest fund. It won't 10 times overnight. It won't make headlines. It won't go viral on Twitter. But here's what it will do. It'll pay you a reliable 3.7% yield. It'll grow that dividend year after year. It'll automatically remove weak companies and add strong ones. It'll adapt to changing market conditions without speculation. And in 2026, with the Reconstitution likely reducing energy concentration and increasing defensive quality sectors, SCHD is positioning itself perfectly for a falling rate environment. If you care about stability over speculation, income over hype, compounding over gambling, and sleep over stress, this fund deserves serious consideration. Let me know in the comments, are you holding SCHD? Are you planning to start a position? Or are you avoiding dividend funds entirely? Thank you so much for watching. I really appreciate your support. And check out another of my videos right here I think you will really like. Take care, and I will see you in the next video.